Hello, everyone, and welcome to the new episode of the Learn and Trade with Popeye. Uh, Today, I want to give a general explanation about accumulation and distribution schematics because it's something that is recurring when I explain charts. So I think it's important we have a common understanding of these two concepts. I try to keep them as less technical as possible and as more logical and practical and pragmatic as possible. And you will see then during the video what I mean in order for you to understand the dynamics behind and the logics behind more than the technical part, because these are concepts that you have to master in order to form a bias, to form your positioning, and so on. Um, so I'll try to show some example in the chart, and I'll try to give you all the explanation I can find to use them logically once you analyze a chart. But before moving to the video, make sure to subscribe to the channel, leave a comment and a like, and make sure you trade with me with Bluefin. Bluefin is a super cool non-KYC exchange. You will find the referral link in the description below to enjoy a 20% discount in trading fees, and you will be eligible if you use my referral link to enjoy all the campaign that we run with the team, including trading bonus, challenges, and much more. But without further ado, let's move to some chart. I prepare a few graphics to show you the concept of distribution and accumulation. As I said at the beginning, I don't want to be too much technical because I'm never too much technical. I'm more on being able to tell a story behind the chart. I'm more into being able to understand the context and be flexible and not be too much dogmatic on rules and procedure. Whatever I've learned and I have developed related the understanding of accumulation and distribution comes from two, let's say, narratives or literature. One is the Wyckoff accumulation and distribution schematic of Wyckoff's market cycle, and the other is more from the ICT concept of trading. You will see that these are very different on the surface, but at the end they discuss about some very similar concept. So first of all, very simply put, you will need to read books and to dig much deeper, but I'll try to keep it short in the video. The week of market cycle is simply saying what we always say, that market can do mainly two things, ranging and trending. So whenever we are ranging before an uptrend, Wyckoff is saying that was an accumulation, following but an uptrend. Whenever we range before a downtrend, Wyckoff will say is a distribution. So to make it simple, during the accumulation, market makers are accumulating that specific stock, crypto, whatever you want, in order to enjoy the uptrend that is following, and during the distribution, market makers are taking profit or opening short, ranging on that time on that area to make sure they are able to fill a big short order or to take big chunk of profit on their position in order then to enjoy the downtrend that is following. As you will see, there is several schematic for both accumulation and distribution in the Wyckoff theory. Now I put the number one for each of them, then you will see that there are differences. But again, this video is not about Wyckoff or ICT. And you will see that it shows you that during accumulation, we come from a downtrend. There is a phase where there is certain aspect of the price action that should happen before reversing. So once this business for Wyckoff is done, then we will have the markup moving higher. Same for the distribution. There is a certain aspect that should happen on the price action. This is how looks the distribution schematic number one for Wyckoff. And once this is done, we are moving lower. Just a caveat for Wyckoff, of course, there is also the reaccumulation and redistribution. Now you will not see it here, but the accumulation is we have a range of accumulation. We started the uptrend. Somewhere here in the middle, we do have a reaccumulation. So again, we range to continue to uptrend. We can have accumulation uptrend, reaccumulation, many of these, until at a certain time market will eventually reverse. We will have a distribution and coming down. Also on the way down, we can possibly have redistribution phase. So it's not simple as this one, but it can be intermediary phase on this move, and Wyckoff has also schematics for this reaccumulation and distribution. A similar concept that you can see we have in ICT is the accumulation, manipulation, and distribution of the ICT. So it's again starting from a range, a consolidation, that is this yellow part, that is the accumulation. There is a manipulation event that is coming outside of the range, then we will see why, to manipulate trader that thinks that this range will break down and go in the other direction, and there is a distribution, so a markup or uptrend that is following these schematics. Same happen for the bearish scenario, where there is a range, there is a manipulation, and then there is a downtrend following. So why I'm showing you these two different concepts? Consider that this was done decades ago, and this is something more actual, more relevant now, because they both speak, according to my view, of a similar concept. That's why it's important you understand the concept and the logic. Once you understand the concept and the logic, then you can become very dogmatic, very technical, but that's not my approach. It's more to understand the logic. As you will see on these schematics, there is a very similar trait on the accumulation or distribution schematic of Wyckoff and the ICT model accumulation manipulation distribution, and this basically the what Wyckoff called the springs, this area here or this area here, and what ICT call manipulation. So what happened in both cases? There is a range, as you can see in this phase here. There is a range coming here. There is a deviation, an SFP or a manipulation or whatever you want to call it outside of the range, and following this manipulation, then the range is broken to the other side. You can see it here, accumulation. There is what Wyckoff call it a spring. Following this spring, the price finds acceptance back inside the range, and there is a markup or uptrend going up. Same in the week of market cycle, you will see there is a spring on the top, and then we move down. Very similarly is what happening in the accumulation, manipulation, distribution of the ICT. You will see that there is the same concept. So we are ranging for some time inside this range. There is a manipulation, a spring, an SFP, a deviation. You can bear trap, bull trap. These stuff have thousands of names, but the concept is always the same. And once this price once again go back inside of the range, we move on the other direction. So the concept is very similar. So enough with the theory. I hope you understand. Again, you can dig much deeper. A 20-30 minutes video will never be enough to explain this concept. I just wanted to give you a general understanding of this theory, but then we can see in the chart what can be the implication and the reading. So what for me is very important when I analyze a chart, and I think it's something that you have to analyze also yourself, is to form a bias and to understand what we are doing. And always we start with the principle that price can do mainly three things: uptrending, ranging, and downtrending. The range can either be, as we explained now, a distributive or an accumulation range. So very similar to the market cycle that we saw. So we can uptrend, what is happening here. We can range, following this range become a distribution. We can downtrend, then we can range again, and in this case, this range become an accumulation, and then we can uptrend. Then, as we say, in low time frame, maybe this is another reaccumulation range. So why you have to master this concept? Because we have to understand what the price is doing. So when we are uptrending and when we are downtrending, there is no confusion. because the uptrend is an uptrend and the downtrend is a downtrend. So very simply put, an uptrend is a series of higher highs followed by a series of higher lows. And a downtrend is the opposite, a series of lower lows followed by a series of higher lower highs. So whatever is the time frame you're checking, if it's uptrend is a clear uptrend, if it's a downtrend is a clear downtrend. I don't know where to show it in Bitcoin. Let me clean this old chart. This time frame, there is no discussion that this is an uptrend in this time frame. There is no discussion that in this time frame this could have been a downtrend or this could have been a downtrend. And there is no discussion that in high time frame this is an uptrend. Okay, so there is no much to discuss in downtrend and uptrend. Where the discussion starts in ranges, because you can say, you can understand, you can see that the price is ranging, okay? Because it's going sideways, so it's failing to make a clear series of high or lows that tell you that is uptrending or downtrending. So you can say that is ranging, but you cannot say, or perhaps it's difficult to say, if this range is an accumulation and a distribution. So that is where the trouble starts, and when all this theory come out to try to help traders to navigate ranges. What is the problem? That in my opinion, or in my approach, I always try to be neutral whenever I see a range. So I'm not sure about the outcome of the range. So if the price is coming something like this and is clearly then starting to range somehow inside this range, I always try to have a almost neutral approach as long as we stay inside this range. There is caveat about this, but to me, ranges are most of the time neutral formation, and as long as we stay inside this range, I will have a 50-50 possibility. I will give it a 50-50 possibility that this range will eventually break up or will eventually break down, becoming, if it break up, an accumulation, if it break down, a distribution, as we explained. So that's why the concept is important. But you will ask, but how you can trade if you don't have an approach? Because my approach in these ranges is always that I want to try to short premium and I want to long discount. So I want to short as close as possible to range high, and I want to short long as close as possible to range low. Because this is, to me, the only approach that will give me a good risk reward and will help me to position positively in case the range will be manipulated on the other side. Going back to the concept that we said before about the possible spring or deviation, possible manipulation in the ICT model in top on the bottom. So hope you're following me so far. So the concept is, this is a range, so we just expect that the price will continue to range here inside. If the price continue to range, if we short here, already we are in the good side, because if we continue to range, we are positioned to move to the other extreme of the range. If we long here, we are again, if we continue to range, well positioned. If the range finally break, we have a position open here if we break down, or if we break here, we have a position ready to move on the other side. When we can start to develop a better understanding of the range and to start to speculate what the range can finally do, in the concept that we saw before about the springs and about the manipulation. So usually a range to break in either direction, so to break like this up or down, will need some sort of liquidity hunt. So what does it mean? That when the price is inside a range like this, there is a liquidity build-up. What is the liquidity build-up? So we know that price started to range because buyer and seller agree that more or less this price is the fair price. So it's called usually mid-range, point of control because it's attracting the price, or fair value area. So here everybody's in agreement that the price here in the middle of the range is good. Why then it keep ranging? Because everybody's in agreement that here the price is at a premium, so it's too expensive. So whenever we reach here, price move down, and we are also in agreement that this price is at discount. So whenever we reach this area, price bounces. So when it's a premium, people selling or open short. When it's at discount, people is buying or closing short, taking profit from short position. So there is three area: premium, range high, value area high, that is rejecting the price; value area low, support or range low, that is bound, making the price bouncing; and mid-range, fair value or point of control, that is attracting the price, that is keeping slicing and being chopping here in the middle. So this is the normal dynamic of the range. So what happened that a lot of people build short position here. They do something like this. So you have many people doing stuff like this. So opening short position along this range, and you have also the opposite with people opening long position at the bottom of the range. Now I'm making it simple, something like this. So what do we need potentially to break from this range finally? We need to have liquidity, fuel, and remove resistance to do either take out all the short. So if you see, if the price go here, all this stop loss of this guy is taken out, all this position is taken out. Taking out that stop loss here will also imply that we take out the taking profit. So if we take this, we will fill very big order, short order here, because their stop loss will be our filling of our order. Then we will remove their resistance here, that was their take profit, and the price will be able potentially to break and move to the other direction. The same could happen for the, let me clean a little bit this, for the other side. Give me just a second to make you see more clearly. The other, it will happen the same on the other side, because if we have a lot of this guy with this position, the price has moved here inside, fill their order, not yet taking profit. So what happened? We move down, we take out all the stop loss so we can fill our order. Price manipulate back inside or make a springs, retest, go up. This position are gone, so this taking profit this guy had here were a resistance, because if the price was reaching this level, or this guy would sell to take profit. So we remove two problems. We add their liquidation to fill a very big amount of order, and we remove a resistance so the price can move above. So this is the key analysis on the range. I will try to make it. So whenever this happens, I can allow myself to see that there was a manipulation, a string, price is back inside the range. Now I can expect that potentially we have the fuel to move up. So whenever this is happening, I can start to speculate that this was potentially an accumulation range, or whenever the opposite would happen, I could start to speculate that this was a distribution. It's a speculation, so I will try to position myself accordingly, but when this speculation will be confirmed, let's say, only when the range will finally be broken. So when the range will be broken and we will start to trade below or above. Very similarly to what happened, for example, here in Bitcoin. Sorry, let me cancel everything. Okay, to what happened here. So this was clearly a range. This was clearly starting to look like a distribution. So we distributed for a while, we went down, this became a deviation. Once price deviated, it got the fuel to finally break above this range. So here we start to have a discussion. So here the discussion, you see, is evolving. Whenever we break down from this, what we say, okay, was a distribution, at least a local distribution. This could be potentially a second distribution, but what we have here, a spring, you see. This range is again deviated, price going back. So this become accumulation, manipulation, expansion, but also this become the manipulation of this bigger range. And both the spring here, now I'll show you better, and both this manipulation gave the strength to finally break from this range. So if you want to see in ICT schematic, this would look something like this. Accumulation, manipulation, a very simple power of three, they call it, or again, accumulation, manipulation, distribution, and distribution. So you understand the concept of what is happening here. What we can potentially say that if this, why you have to understand the concept, if this end up doing something opposite like this, we would have the same game, but we don't know until the range are holding. Do you see? So if we make the color, this is the accumulation, this is the manipulation, and here there was potentially an expansion. But we can have something similar here. Still not happening because we are still holding there above. You see, same game repeating. So the concept that you have to understand that many times price is ranging. You have to try to understand what the range is doing. So as I was saying before, also we can consider this as a very clear spring or range deviation. Here there was a very well established range. And here was a typical spring that we saw at the very beginning on the Wyckoff schematics. So why these levels are important? Whenever the range, so to try to give you the juice of all this discussion, whatever the range is reaching is extreme, that is where you want to pay attention. So we don't care about what is happening here. We don't care about what is happening here. We don't care about what is happening here in the middle. Never. We don't care about this. Our attention is always at the extreme. You will see why the attention at the extreme is fundamental, because by accident I took this three range, and this three range always happen. Look at what happened. So this is the range. We got a spring that gave you the move from here to the top. Here, once again, we didn't break out to that spring, and it gave us the move down. Here again, we get a spring. Again, find acceptance above, and it gave us the move to move up. Again, here we got a spring, and it gave us the move to go up. So this could have potentially give the fuel to break. It failed, it never break. We spring again, we went down, we distributed for a while, we accumulated, we reaccumulated, and we move higher. So all the attention is always at the range extreme where you want to position. My approach, as I say, is always 50-50 when we are still inside the range, and it becomes interesting when the range is deviating and we move up. I will not consider this, as you see, as a proper breakdown inside the range. You always want to see a market structure break in the other direction, like it happened here, like it happened here, bearish, bullish, bearish, bullish, as you can see here. So this is the concept, as you can see very quickly on the last 8 months of price action in Bitcoin, how clearly visible it is. So the important is for you to understand that why range existed, what is their function, accumulate, distribute, reaccumulate, redistribute, how you want to position in this range, and how to try to be always in the right side of the market. Range will eventually fail, as we saw here, failing, then failing, then failing. So will eventually break. You always try to be in the right side, so you don't short discount and you don't long premium. As simple as that. I think already we have a lot of concept, so just a reminder before giving you some pro tips and some summary, a reminder that whenever you want to trade ranges, distribution or accumulation, do it with Bluefin. You will find the referral link in the description below. You will enjoy a 20 discount in trading fees, but you will be eligible to join a lot of campaigns with trading bonus, challenging, and so on. Also, I do frequent giveaways for the people users that use my referral link. And also remember that Bluefin is a non-KYC exchange. It has a lot of liquidity. You just need an email address to register, and you're good to go without providing any personal information. So make sure you click immediately on the link in the description below, and you start to trade with me on Bluefin. A pro tip I want to share, it's the use of volume profile in the ranges. This you will find, the last video I posted before this was on volume profile, so you can find better explanation on this. But the point of the volume profile that will help you to understand if price is really finding acceptance outside of the range, so if the range is finally broken. So if we, you can use the fixed or the visible is pretty much the same. You can see that in this range, the volume was more or less here. Sorry. So this action, call it auction, in this range resulted in a positive action when we started to find acceptance above it. Or you can check the fixed volume profile. You will find video on both. This will give you, you see, value area I, this blue line. Whenever we find acceptance above the value area I, then we know that this action works. When we can call potential deviation, when we go back inside the range. So as long as we stay above the volume node, or as long as we stay above value area I, you consider the range broken. Good, as it happened here, you see there was this node here and value area low given by the fixed profile. Here we saw a breakdown, but then price find acceptance back inside the range. So this was a failed auction. Actually was a deviation, was a manipulation, was a spring, a bear trap, price find acceptance back above. So now our bias completely changed and we're looking for a move to the other direction. So you can either use fixed or visible range volume profile in order to give you some level to monitor to understand if the range is broken or if it's simply deviated. You will find video on both the concept on the Learn and Trade series. If you see, I can give another example here down here with the fixed volume. We start from where the price starts to range. We go until the range is broken. You can see that if this was value area low, in this case to be precise, the price action was until here. So value area low was here. What happened? I selected this area because I want to see what happened when we were here. We deviated, we find acceptance back above value area low, we retested and we move to the other direction. If I want to see what happened when we finally broke up somewhere here. As you can see, this was a good action. The price never come back. So we saw how this action was a failed action. So below value area low, back inside the testing going up, and we can see that this was a positive auction because price broke above, never came down back below value area high, and started to move above. So these are some pro tips that you can use, either the visible or the fixed range, in order to better map and understand if there is a deviation, of spring, or if the action is the positive one and is moving the price to the other direction. This is the little pro tip. The other pro tip is that you can find, again, as one of the first video here in the Learn and Trade series with Popeye, my strategy to trade range deviation. So this is a little bit a long concept, but you will understand in that video how I physically then take trades on this concept. So to summarize, we know that price can do three things: uptrend, range, downtrend, and range. Range, that is the discussion of this video, have two functions, mainly three functions: distribution, accumulation. Sometimes you can have a range here that becomes a manipulation to move the price on the other direction. So there are two main schools that teach how to interpret ranges, is the Wyckoff and the ICT. I take a mix of both with a bit of salt, and I never try to form a bias within the range if it's accumulation or distribution. What I try to do is just to position myself short at the premium and long at discount. So short at the top of the range and long at the bottom of the range. I try to adapt my bias and I start to have some sort of expectation whenever there is a manipulation event or a spring or a deviation. So whenever we see price finding acceptance above range high or below range low, and we see a strong reclaim of that level, we can start to consider that move as a manipulation event or as a deviation, as a spring, as a bull trap or rubber trap. And in that case, we can start to have assumption that market makers, whales or whatever, have created enough fuel to move to the other direction. So in that case, we can start to assume or speculate that a specific range is becoming an accumulation or a distribution. The last important part, then, whenever a range is broken, you have to think proportionally. So if we have a range for many months, many days, many weeks within a range, if that range is finally broken up or down, remember to apply a proportionality concept. So if a range is broken to the upside, so it's resulting in being an accumulation range, it was a very long accumulation range, consider that after a very long accumulation range, there will be potentially a very long uptrend or markup, as Wyckoff explained. So remember, positioning long and short, premium and discount, be aware of deviation and the consequence, and always apply a proportionality concept. I think that is enough for today for the distribution and the accumulation concept. We can go much deeper if you want in lesson number 2, but for the moment, let me know what you think about this video. If you have any question, if all was clear, remember to trade with me on Bluffin. You will find the referral link on the description below. And before leaving, make sure to leave a comment and a like and subscribe to the channel. It's everything for today. Take care. We'll see you in the next one. Bye.